Macro pop quiz. Money and banking. True, false, or uncertain. The M1 money supply includes cash in circulation, checking deposits, and highly liquid savings accounts. The answer is false. By standard textbook convention, M1 covers cash and demand deposits, savings deposits below. Macro pop quiz. Money and banking. True, false, or uncertain. In a fractional reserve system, banks must legally keep 100% of deposits in cash at all times. The answer is false. Banks keep only a fraction as required reserves and lend out the rest. Macro pop quiz. Money and banking. True, false, or uncertain. If the required reserve ratio is 10%, the simple deposit multiplier is exactly 10. The answer is true. The simple deposit multiplier is 1 over the reserve ratio. 1. Macro pop quiz. Money and banking. True, false, or uncertain. Raising the required reserve ratio limits banks' ability to create money through loans. The answer is true. A higher requirement forces banks to hold more cash, leaving less available. Macro pop quiz. Money and banking. True, false, or uncertain. The money multiplier is usually smaller than the simple deposit multiplier because of cash leakage. The answer is true. When the public holds cash instead of depositing it, less money is multiplied. Macro pop quiz. Money and banking. True, false, or uncertain. An external injection occurs when the central bank directly increases the monetary base. The answer is true. It adds new high-powered money to the economy, for example, through open market. Macro pop quiz. Money and banking. True, false, or uncertain. An internal injection increases the total monetary base of the economy. The answer is false. It only moves cash from the public into commercial banks, leaving the total base. Macro pop quiz. Money and banking. True, false, or uncertain. If the public holds more physical cash and less in checking accounts, the money supply contracts. The answer is true. Cash leakage drains reserves from banks, reducing their capacity to. Macro pop quiz. Money and banking. True, false, or uncertain. The term fiat money means a currency backed by a physical commodity like gold or silver. The answer is false. Fiat money has no intrinsic value and is backed only by government decree. Macro pop quiz. Money and banking. True, false, or uncertain. When the central bank buys government bonds from the public, the money supply expands. The answer is true. It pays sellers with newly created money, injecting cash direct. Macro pop quiz. Money and banking. True, false, or uncertain. Under the quantity theory MV equals PY, more money always raises real output in the long run. The answer is false. In the long run, output depends on resources. Extra money. Macro pop quiz. Money and banking. True, false, or uncertain. The classical dichotomy says nominal variables like the money supply don't affect real variables long run. The answer is true. Money changes prices and wages over the long run, but leaves real production. Macro pop quiz. Money and banking. True, false, or uncertain. If velocity v is perfectly constant, a 5% rise in the money supply must raise nominal GDP 5%. The answer is true. Since MV equals nominal GDP, with V fixed, any growth in M. Macro pop quiz. Money and banking. True, false, or uncertain. The inflation tax is the loss of purchasing power borne by people holding cash during rapid inflation. The answer is true. Funding spending by printing money inflates prices, implicitly taxing anyone holding. Macro pop quiz. Money and banking. True, false, or uncertain. A liquidity trap occurs when nominal rates are near zero and money demand becomes perfectly elastic. The answer is true. At near zero rates, the opportunity cost of holding cash vanishes, so people hold. Macro pop quiz. Money and banking. True, false, or uncertain. In a liquidity trap, lowering short-term policy rates loses its effectiveness as a tool. The answer is true. Rates can't be driven much below zero, so conventional cuts can no longer. Macro pop quiz. Money and banking. True, false, or uncertain. Quantitative easing involves the central bank buying long-term assets to lower long-term interest rates. The answer is true. It's an unconventional tool that pumps liquidity directly into long-term. Macro pop quiz. Money and banking. True, false, or uncertain. Monetary sterilization is used to offset the inflationary impact of large foreign exchange interventions. The answer is true. After printing currency to buy foreign exchange, the bank sells domestic bonds to absorb. Macro pop quiz. Money and banking. True, false, or uncertain. If banks hold excess reserves above the requirement, the actual money multiplier exceeds the theoretical one. The answer is false. Holding excess reserves means lending less than possible, lowering the macro pop quiz. Money and banking. True, false, or uncertain. When the central bank raises its policy rate, the market value of existing fixed-rate bonds falls. The answer is true. Bond prices and rates move oppositely. Older, lower-yielding bonds lose value. Macro pop quiz. Money and banking. True, false, or uncertain. Real interest rates can be negative if inflation is strictly higher than the nominal interest rate. The answer is true. By the Fisher equation, the real rate is the nominal rate minus inflation. So higher inflation. Macro pop quiz. Money and banking. True, false, or uncertain. The central bank lending rate is the rate commercial banks charge their best corporate customers. The answer is false. It's the rate the monetary authority charges banks seeking. Macro pop quiz. Money and banking. True, false, or uncertain. Even with slightly negative nominal rates, depositors can avoid negative returns by holding physical cash. The answer is true. Currency guarantees a 0% nominal return, acting as a practical floor against deep. Macro pop quiz. Money and banking. True, false, or uncertain. Monetizing national debt by printing money to repay all government bonds can cause very high inflation. The answer is true. Flooding the economy with cash without more real output erodes the currency's. Macro pop quiz. Money and banking. True, false, or uncertain. Commercial banks create money when a new loan digitally credits a borrower's checking account. The answer is true. Banks don't just lend existing cash. They create brand new demand deposits. Subscribe to Macroeconomics with Michael. Like, share, and drop your answer in the comments.